Assalamu alaikum. My name is Jawad Khan and I am from LBBA third semester. Now I'm presenting you the principal accounting chapter 1, 2, 3, and today's my topic is principle of accounting. So now I'll present chapter 1 accounting for decision making. The first chapter is divided to introduce the terms and techniques that are used in the remaining chapters. Many of the key concepts are introduced here that are used in the remaining chapters of the book. First of all, we'll discuss about the accounting process. The accounting process then into converted into accounting formation, decision makers, economics activities, accounting decision makers with economics activities and with the result of their decision making. So, accounting links decision makers with economics activities and the result of their decision. Our first task as accountant is to identify those economics, even that may be recorded in the accounting system. Once we have accumulated that necessary economics information is a readable format, decision makers use the information to improve the decision making process. Decision made will impact future economics activities which will find their way into the data accumulation process. Types of accounting information. There is three types of accounting information: financial information, tax information, and managerial information. Now we will discuss about the financial information. The first in financial accounting information that is primarily used by external parties. And now we will shift to tax information. Tax information is used to help organization complete obligations to report the internal revenue services and other regulatory agencies. Now we will discuss about managerial. So managerial accounting information used by a person with the organization to help manage and control business processes. Financial information provides information user groups three types of financial information provided decision support. And then information user, investor, creditors, managers, owners, customers, employees, regulatory, SCIRS, EPA, and financial information provide profitability in financial position, cash flows, and decision support involved that performance evaluation, stock investment, labor relation, resources allocation, lending decision, borrowing. Investor creditors, owner, customer, and regulatory agencies are external user of financial information. Managers of business operations are internal user of accounting information. Both external and internal users are interested in the profitability, financial position, and cash flow of the entity. Profitability is often measured on the income statement prepared for the company. The statement of financial position, also known as the balance sheet, report the financial position of the company at any point in time. The statement of cash flow report the cash inflow and outflow during a period of times. The examination of the financial statement of a company leads to decision about the economic viability of the company. The assessment may impact the company ability to raise money in the capital market or negotiation with labor union. Now, basics function of an accounting system. Interpret and record business transaction. The first steps in the accounting process is to identify and record business transaction. Auto identification of economics event that can be recorded by accountant is a difficult process. Classify a similar transaction into useful report. After the economics information is gathering and recorded, we must classify similar transactions so they appear on the proper financial report. We will spend a significant amount of time mastering the preparation of basic financial statement. Summarize and communicate information to decision makers. Once the information is being properly grouped, the result may be communicated to user of information. If the information is to have meaning, it must impact the decision of an informed users. External users of accounting informations, there are owners, creditors, labor union, government agencies, suppliers, customers, trade association, general publics. Provide information useful in making investor and credit decision. Provide information about economics, resources, claims to resources, and change in the resources and claims. Provide information useful in assessing amount, timing, and uncertainty of future cash flow. Provide information useful in making investment and credit decision. Objective of financial report the objective of financial report go from the general objective to the specific. The most general objective is to provide information useful in making investment and trade decision. A more specific objection is to provide information that is useful in assessing the amount, timing, and certainty of future cash flow. Without positive future cash flow, a company cannot sustain operation. The most specific objective is to provide information about economics resources, claim against the resources, and change in the balance of resources and claims. Now we will discuss about the objective of external financial report, balance sheet, statement of cash flow, the primary financial statement. There are three basic financial systems that we will study in the courses. These three include the balance sheet, income statement, and statement of cash flow. The balance sheet is often referred to as the statement of financial position because it shows the resources of a business and claims against those resources. The income statement is often referred to a statement of operation. This financial statement measures the revenue earning by company during a period of time and the expenses incurred to generate those revenues. The statement of cash flow provides information about where the company got its cash and where it spent cash during a period of times. Characteristic of externally reported information. A means to an end, useful, enhances through explanations, broader financial statement based on the general purpose assumption, historical natures result from inexact and approximate measures. User of internal accounting information in which board of directors, chief executive officers, chief financial officers, vice president, business unit managers, plant managers, store managers, line supervisor. These are internal accounting informations. Objective of management accounting informations to help achieve goals and missions, to help evaluate and reward decision makers. Unlike financial accounting information, managerial accounting information is developed to help manager achieve the goal and mission of the organization. The information can be used to evaluate the performance of the manager who are responsible for decision about directing and controlling resources. Characteristic of management accounting information, timelines, identify decision makers, a means to an end, a measure of efficiency and effectiveness oriented toward futures. Integrity of accounting information, institutional features in which general accepted accounting principle, which we call GAAP, GAAP, and financial accounting. General accepted accounting principle, financial accounting standard boards, securities and exchange commission, internal control structure, audit legislations. The Financial Accounting Standard Board is recognized as the group in the private sector that makes specific accounting principle. If an accounting depart from the principle established by the FASB, proper disclosure of the departure must be made. In the public sector, the Securities and Exchange Commission has the authority to establish accounting principle for companies reporting to the agencies. Currently, the Securities and Exchange Commission has accepted all pronouncement of the PASAP for use by reporting companies. Integrity of accounting information. Professional organizations, American Institute of Certified Public Accounting, Institute of Management Accountant, Institute of Internal Auditors, American Accounting Associations. One of the most influential professional organizations in accounting is the American Institute of Certified Public Accountant or IACPA. It represents the interest of CPA, the Institution of Management Accountant or IMA, and the Institution of Internal Auditor or IIA represent the interest of accountant and the auditor working with the organization. The American Accounting Association is composed of a member from academic. Your accountant instructor is probably a member of the American Accountant Associations. Competence, judgment, and ethical behaviors, which are certified public accountant, certified in management accountant, certified in internal auditing, code of professional conduct, and CPA. CPA is which one? Certified public accountant. Ethical behavior is the cornerstone of the accountant professional. Recently, we have seen many corporate scandals involving individuals who acted in unethical and oftentimes illegal ways. Ethics is the belief system that permits us to distinguish right from wrongs. It is the sometimes that we develop over our lifetimes and services to help us identify good and bad behaviors. Professional organizations have promulgated codes of ethics that must be followed by members of the organizations. Careers in accounting, public accounting, management accounting, government accounting, and accounting education. Careers in accounting can follow many paths. There is a great demand for financial accounting in the preparation of financial statement, dealing with the regulatory agencies like the Internal Revenues, Services and Consulting, Management Accounting, help tracks product costs, prepare budgets, and service as a consultant to managers. The field of taxations include everything from the preparation of tax returns to consulting with clients about estate and gift plannings. And now the chapter 1 is come to an end, and now we'll start chapter 2, basic financial statement. In basic financial statement, we will study about the introduction to financial statement. What is financial statement? Financial statement is a structured representation of the financial position, balance sheet, financial performance, income statement of entity, and the inflow and outflow of cash, what we call cash flow systems. Statement. The objective of financial statement is to provide information about the financial positions, the financial performance, and the cash flow of entity, which we study the financial statement also help to assess the probability that enterprise will be able to make future cash. And the basic financial statement depict the revenue and expenses for a designated period of times. Income statement is called the balance sheet is called describe where the enterprise stand at a specific data. Statement of cash flow depicts the way cash has changed during a designation period of time. These financial statements are a window to a company's performance and health. The balance sheet. Now we will discuss about what is balance sheet. The balance sheet represents a record of a company asset, liabilities, and own equities at a particular point in a time. A balance sheet is named by the fact that a business financial structure balance in the following manners: assets, which is equal to liability plus shareholders' equity. Asset represent the sources that the business own or control at a given point in a time. This include items such as cash, inventory, machinery, building, etc. On the other side, we will discuss about the liabilities and non-equities. The equations represent the total value of the financials the company has used to acquire those assets. Liability represent debtor, while equity represent the total value of money that the owners have contributed to the business, including retained earning, which is the profit made in previous years. The balance sheet we will describe in three slides: assets, liability, equity. Assets, which are cash, inventory, land, building, equipment. account receivable securities and is equal to liabilities plus owner equity. Liabilities accounting payable, wages payable, taxes payable, notes payable, short terms and long terms. Equity, preferred stock, common stock, retained earning. Why do we need balance sheet? Because balance sheet provide investor with a snapshot of a company's sales as of the date provided on the financial statement. If a company assets are large relative to liability, it's, it is in good shape. Conversely, if a company with a large amount of liabilities relative to asset has risk to creditor, the higher the debt ratio, the greater risk will be associated with the firm's operation. In addition, high debt to asset ratio may indicate low borrowing capacity of a firm, which in turn will lower the firm's financial flexibility. The income statement. What is income statement? The income statement shows information about the revenue, expenses, and profit that was generated as a result of the business operations for the period of and it's where a company performance over a specific time frame. The component of income statement are revenue, expenses, net income before and after taxes. In revenue, we'll discuss how much the company earned, expenses, how much the company has spent, and taxes, we will discuss the profit of the company. Why do we need an income statement? Because we need income statement. Answer the question: how well is the company business? Does it performing well? Basically, the question is it making money? Firms with low expenses and high profit relatives to a revenue are typically more desirable for investment because it brings more money directly to a shareholders. The statement of cash flow. What is statement of cash flow? And now we'll discuss about the statement of cash flow. The statement of cash flow represent a record of business cash flow, inflow and outflow over a period of times. It is the most sensitive statement and it focuses on the following cash related activities. Suppose operating cash flow, cash from investing, cash from financing. Operating cash flow are cash generated from day-to-day business operation. Cash from investing are cash used for investing in asset as well as the proceed from the sale of other businesses equipment or long-term assets. And cash from financing are cash paid or received from the issuing and borrowing of funds. Now, why do we need statement of cash flow? Statement of cash flow is very important in an investor because it shows how much actual cash a company has generated. It shows the ability of a company to generate cash. Many companies have shown profit on the income statement but struggle later because of insufficient cash flow. Because the debt income statement includes non-cash revenue expenses which the statement of cash flow exclude. It show correct figures of firms because cash flow statement is very difficult for a business to manipulate a scarce situation. Earning can be manipulated, but it's tough to pay cash in the bank. For this reason, some investors use the cash flow statement as a more conservative measure of the company performance. Uh, Bringing the financial statement all together, the three financial statement, balance sheet, income statement, and cash flow statement are all related. And the change of asset and liabilities that is indicated on the balance sheet are also reflected in the revenue and expenses which are set on the income statement, which show the company gain or losses. Cash flow provides more information about cash assets listed on the balance sheets and are related but not equivalent to the net income shown on the income statement. So here therefore no one financial statement tells the complete story of firms. Accounting principle. Certain accounting principle data are important for an understanding of financial statement and how professional judgment by accountant may affect the application of those principles are shown in the next slides. The concept of business entity. Suppose ABC company, a business entity is separated from the personal affairs of its owners. Assets, cost principles, stable dollar assumption, going concern assumption, objective principles. These accounting principles support cost as the basis for asset valuations. The cost principle tells us that accounting information is based upon the actual incurred. We refer to this as a historical cost. The going concern assumption state the business entity is assumed to continue operation into the futures. The objective principle state that the accounting information must be unbiased and based upon independent evidence. Stable dollar assumption or the stable dollar assumption tell us that we will only record accounting information that can be expressed in monetary units, usually a dollar in the United States, and the dollar will remain constant across fiscal period. Fiscal period means annual years period. Statement of financial position, a starting point. Suppose ABC company balance sheet. Here we draw from January first to in the right side we will write okay, assets, and the left side we will write liabilities and non-equities. Suppose cash we have $22,500. Notes payable is 10,000. Receivable is 6,500, and so on. And the other side's liability, we will write notes payable, which will pay in upcoming days, accounting payable, salaries, payable, liabilities, equal stocks, retained earnings. So then the balance sheet in the right side, the total amount, and the left side, the total liability plus one is equal to this, and both are must be the same amount. Here is some examples of ABC company sheets, balance sheets, and asset is equal to liability plus owner equity. Business transaction affect the elements of the accounting equations. Asset is equal to liability plus owner equities. In the next class, we will demonstrate how certain business transactions affect the elements of the accounting equations. Forms of business organization. There are three forms: sole proprietorships, partnerships, and corporations. Uh, Forms of a business organization. Most business organizations are organized as a sole proprietorships, a partnership, or a corporations. Sole proprietorship it's unincorporated business owned by a single persons. Partnership is incorporated business owned by two or more persons agreed to act as a partners. And a corporation is a type of business organization that is recognized under the law and entity separate from its owners. Reporting ownerships, equity, sole proprietorship, partnerships, and corporations. Now here the chapter 2 is come to an end, and we will start the chapter 3, the accounting cycles, capturing economics events. So here the role of accounting records, establish accountability of for assets and transaction, keep tracks of routine business activities, obtain details information about a particular transactions, evaluate efficiencies and performance within companies, maintains evidence of company business activities. The ledgers, cash, account, payables, capital stocks. Accounts are individual records showing increase and decrease. The entire groups of account is kept together in an accounting records called ledgers. Let's see how debit and credits are recorded in the cash account for Judges Loan Care Services. So here they are recording the debit credit entries, which is showing the this slides. The balance is the difference between the debit and here 5 divided by 31 is equal to 4125. So the balance is the difference between the debit and credit entries in the accounting. Debit and credit rules. There is two rules of debit and credit rules. Debit and credit fixed account is follow. Asset is equal to liability plus owner equities. Asset debit for increase, and the asset which is increase will be come to debit for increase, and credit for decrease. Liabilities debit for decrease, and credit for increase. Equities debit for decrease. Equity when the equity is debited, it will decrease, and when the equity is credited, it will increase. Double entry counting the equality of debit and credit, which the same as asset is called debit balance and liability plus one equity is called credit balance. In the double entry counting system, every transaction is recorded by equal dollar amount of our debit and credits. Let's record select transaction pauses launch cursors in the content, which we have discussed some times ago. And now, will cash increase or decrease? Will capital show increase or decrease? Now here is the some numericals which they overviews of the accounting cycles. Analyze transaction based on source documents, generalize post chapters, prepare and adjust trial balance, adjust and prepare just trial balance. Here is prepare financial statements, close. Step and process transaction, which is step one is examine source documents, analyze transaction. Remember the steps. Now let's look at some additional steps. Steps one is equal to journals. Uh, Step two is record transaction journal. Step three post the journal information. Step four prepare and adjust trial balance. Recording transaction also called original book of entries. The process of recording the transaction is called generalizing. An example follows general journals, which we write in below. Posting involves copying information from the journal to the ledger account. Formatting convention. Generally, dollar sign and rupees signs are not used in the journal or ledgers. Round numbers a financial statement to the nearest dollars. And here it's come to an end. Now my presentation come to an end. Goodbye to see you.